All right now, is the heartbeat of the market skipping? Well, not anywhere close to 20,000. Nowhere close to 20,000. But where is Infosys? Let's just go to Infosys. We'll talk about the bank Nifty in the small cap index later on. 9% lower for Infosys, and it is not 9% lower for a bellwether stock. It is not at a 52-week low, but it's gone to 1325. Now these are very early days. You don't know at what price it will recover. It'll start making a comeback. Let's skip and go to other IT stocks. TCS, TCS, Wipro, HCL Tech. TCS is down 2%. TCS is not complaining about fat deals, not a large order pipeline not going through, but the sentiment impact, I think, is so damaging because of Infosys that just one of the phases which Avan insists that I keep on using again and again, I will use again, that it's a case where Infosys has sneezed and the rest of the IT pack has got flu.
Absolutely, and a bad flu at that, because I mean, TCS falling 2.25% when their numbers weren't bad, or HCL Technologies with that 3% cut. Tech Mahindra has slid 5%. Wipro is down 3%, so it's quite unfortunate. Having said that, there are also weak numbers from a Persistent, wherein their CC revenue has come in higher by about almost 3%, but TCVs have fallen 10% sequentially. Persistent as well has cracked down 4% right now. Emphasis, wherein the BFS revenue has come in lower by nearly about 8% or 9% actually on a sequential basis, and the CC revenue also has seen a downtick of about 3.5%, much lower than what the street was anticipating. Emphasis too has slid about 3.25% as we speak right now. Now let's address Unilever. What is that up to then? Because there too there was an earnings disappointment. The volume growth at 3% is definitely lower than the averages that the street was penciling in. Unilever down a good 2%, and you know, for Unilever to fall 2%, because Unilever is not really a high beta stock. You don't see very steep moves come in on that, so that's a little bit material of an earnings reaction coming in. Let's address the good news now. L&T. The board is going to be considering a buyback and a special dividend on July 25th. L&T has gapped up 3% as we speak right now. What is Reliance up to? Are you seeing any green or red on that stock? Let's check in on that. That's Reliance for you, 2588. Let's also address the 51st or 51st stock on the Nifty, Reliance Geo Financial Services. What is that stock up to? That too will just come up for you on your screens, considering since yesterday we've got 51 names on the index. That intraday graph will also just come up for you on your screens now. This United Spirits, that's the big blowout number this morning. The Q1 revenues have come in above estimates, volume growth at 10%. That's managed to beat the street estimates. So that stock should be up in the green. USL is what I'm talking about, 1% higher. India Mart, good numbers there. Share buyback of 500 crore rupees, a board approval coming in for that, 3.25% higher for India Mart. Tanla Platforms, that's also a good earnings reaction. ICICI Securities, the profits have come in higher, nearly about 3.5% on a sequential basis. There's also Union Bank. The CASA ratio is lowest in about 12 quarters. Cost to income ratio lowest in 14 quarters. Good numbers from Union Bank, 4% higher there. And 361 as well, wherein the revenues have risen 3.25% and the profits are higher, 17% on a year-on-year basis. These are a couple of numbers which we're looking out for. So yes, IT sticking out like a sore thumb. There's Unilever reacting to its weak numbers, but the rest of the market is looking okay. I mean, to have the IT index fall the way it is, Kunal, the Nifty is still clinging on to 19,800.
There are two good things which have happened on the opening.
Good things?
Good things.
Okay.
Yeah. Because the bank Nifty is still flat to positive. Flat to positive. The Nifty futures yesterday when it closed at sub to 20,000 was at a discount of 15 points. Okay. Very rarely do we see that when the index is moving up in high momentum, the index futures is at a discount, because when you are exuberant, you would tend to buy the futures. So the premium has come back again for the index. Now we are at a 50-point premium for the current series, which I think is a good sign for the index that we should try and stabilize at this level of 19,800 approximately for the index. In terms of opening trade, I would look out for ICICI Bank as the opening trade, expecting that the strength of the bank Nifty would continue on the basis of many of these private sector names. So that's a stock which I would look to trade in the open.
Naresh, what are the first trades that you're punching in?
So going defensive, liking NHPC, that's a stock which could make a move towards 55 in the short term. Looks interesting.
All right, Vineet Samra joins us now. Vineet, good morning. Thank you for joining us. Joining from office, joining from work. Have you managed to reach on time on this rainy Friday morning?
Good morning. I had to leave quite early today just to sort of have some cushion.
But there is no cushion for IT investors.
Yeah.
Just no cushion. What's gone wrong, Vineet? I mean, 2 quarters ago, all IT companies, they came out and said the following: all is well, and AI is not an opportunity. It is not a threat. It is an opportunity, and we are getting fat deals. But in between 6 months or less than 2 quarters, the commentary has changed 180-degree. What has gone wrong? I mean, I do not challenge the spirit of some of these IT companies. I mean, they are good corporate managements. It is just that they've not been able to understand the environment, I guess.
So I think clearly, Nikunj, what you mentioned is very important, that the environment itself is very fluid. As we were actually interacting with the IT managements over the last maybe 1 or 2 quarters, I think this was clear that there is delays which are taking place. Clients' decision making is a bit delayed. But what these managements were sort of also alluding to was the fact that the deal pipeline looks okay, which I think, anyways, when we look at the numbers, most of the companies, if one focuses on the deal pipeline, those are okay. The other thing which I think the managements have been guiding towards is the fact that while transformational deals may be sort of difficult to come by, but some of these efficiency related deals or cost takeout deals, those are still coming up. So a question to me actually in my mind is that some of these cost efficiency deals, if they are actually improving, they shouldn't be seeing delays in terms of starting, because if the companies over there are worried about a slowdown, they should be in fact looking towards enhancing or accelerating the deployment of the cost takeout deals. So that is something which I sort of not getting clear answers to. But let me say one more, the other thing which I feel as far as the IT sector is concerned, while we may keep going through these ups and downs and these sentiments, like you were saying a few minutes back, sentiments is what actually drives these short-term moves. But I think I would sort of go on the side of this aspect, that all the whatever I have read and we have interacted with the management, the artificial intelligence or the machine learning, all of these are only going to create a lot of more business opportunities. More and more companies are wanting to sort of look at those as a matter of adapting in terms of their businesses. So I think eventually these things will play out. What we are also seeing is that there are delays, and we should anticipate that at some point, maybe in a quarter or two, things should see some normalization. So at a price point is what I would suggest that one should look at the IT sector. At, let's say, 5% of dividend yield, some of these large caps really become good, attractive. So rather than focusing so much on the noise in the short term, I think if one takes a slightly longer term picture and buy at a right valuation, maybe that should be a good strategy.
I mean, and I'm just bringing this out for the benefit of our viewers, getting so many messages and so many, comments on social media that it's over for IT. No, it does not work this way. Indian IT sector has gone through 2008, Y2K, enterprise, digital. These are companies which generate so much of return on equity and return on capital and so much of cash that this sector's ability to come back. Now, growth, of course, will get compromised. Vineet, I'd like to draw your attention to something which you've really specialized in, understanding the small and the mid-cap space. Some of your peer AMCs have stopped accepting lump sum flows into small cap funds. What is your understanding of the positioning and the risk reward ratio for the small cap universe per se right now?
See, I think overall, if we just maybe look at the last 3 months or so, the way we have seen the markets actually move up, and it's a broad-based rally which has actually taken into consideration the mid caps, the small caps, and all across we have seen a significant up move. And especially if you look at YTD, the large caps maybe have gone up by 10 odd percent, but the mid and small caps have gone up by almost 17-18%. So that's a massive up move in the last maybe YTD. So I would say in terms of valuations, definitely when we see such sharp moves, I think that creates a certain amount of worries in our mind. While For a large pool of investors, as it goes up, the risk seems lower, but on the contrary, as it keeps going higher, the risk actually also keeps going higher, which is not generally considered at that point in time, because the narrative is that everything is okay and people are choosing to not consider the risk at that point in time. So I would say that while the valuation risks remain in a lot of pockets, but on the whole, if I look at the comparisons of valuations across the large cap, mid cap, and small cap, I would say that small caps are relatively still well priced. There could be pockets of hyper valuation in some of the categories, but there are few categories where the valuations are looking reasonable. So I think from that perspective, it is okay to own some of these small caps, as we consider that the next few years the broad-based economic growth will aid the good companies' growth across the mid and small caps as well. So I think from that perspective, one should take that long-term view and hold on. But also from the sensitizing the risk of valuations, I think if one has gotten extraordinarily, overexposed to the category, I think there's no harm in actually cutting down some bit of that exposure as well.
At the current juncture, Vineet, if you have to keep it very simple for the benefit of our viewers, what to your mind is the most overrated sector or theme, and similarly the most underrated theme stroke money making potential?
I think it's very simple, Nikunj. So today we look at all these. I get worried when I look at the valuations of the engineering, capital goods, manufacturing theme. So see, there is a fundamental backup, but I would say that there is a lot of narrative which is actually also pushing the valuations, higher. So I would like to caution investors on that category. While we have certain amount of exposures in our funds as well, but we also have time horizons. We know that over long period these will do well, but in the short period, I think they have moved ahead of their fundamentals. So one has to be cognizant of that fact. On the other hand, the category which has not seen maybe interest of investors for valid reasons, but I think those data points are also changing and making us more positive, is the pharmaceutical companies, where we have been. So I've been calling out the positive view on that for a while, but it has not worked. But I believe that the data points now seem to be turning. We have US markets which are now sort of facing shortages of drugs. Indian markets are pretty okay, 10-11% growth. You mentioned for IT, cash flow, ROC. I think that holds true for the pharmaceutical sector as well. So I think these two, I think, are two different sides of the poles, but and it's all about the sentiments when the sentiments change. So I think that's where I would sort of like to answer your question.
Vinit, many in the market are now believing that if it's not IT, the market is going to fall back upon banks, right? And you saw traces of the underperformers as well come back to the fore. Case in point being Kotak Bank, when at a time we were just 20 points away from the 20K mark on the index. That was actually performing and was one of the biggest movers on the index yesterday. Do you think banks will have to do the trick for the markets to push higher?
So I think independent of how the markets are going to see the short-term changes, but I would say that banking relatively seems okay from two considerations, and I will also sort of mention what are the concerns which are sort of being spoken about. But I think one, the banks' balance sheet today are in the best form. The quality of assets or credit quality is also in the top form, and as of now, at least, we don't see signs of those deteriorating. Maybe if there are large levels of IT does look to scale down number of people. I mean, those eventually will start hurting, but we'll see as and when it actually happens. But as of now, I think the credit ecosystem looks pretty strong. The credit growth looks okay. And from that perspective, and also valuations, if we consider valuations, I think the banks have been, trading in the on less than the last 5-10 years averages, marginally less. They've moved up, but they're still okay in terms of valuation. So I would say that it's okay to have exposure to the banking sector, and especially I would say that if the view also eventually comes that interest rates have peaked and at some point it starts coming off, then I think the NBFCs within the banking space would make a slightly better case. And what is a worry which I was talking about? The worry is that in general the view also is that the NIMs have peaked out because the interest rate are at the peak, and once it starts correcting, the NIMs will also see some pressure. But considering the fact that the credit growth is high and some amount of giving up on NIMs, I think that would still yield a decent growth in the profitability, and I think that is what one should sort of focus on.
If I'm going to switch gears and then talk about the other capex dominated theme, defense, railways, how should one position in those themes? Because they are right now the real darlings of the market.
Yeah, so I think any sector assessment has to be considered from two viewpoint. One is how does the long-term picture looks like? Does the companies, they have the ability to sort of sustain their momentum, and they have the entry barriers which they have created. I think some of these companies, businesses, they do have that long-term mode, if I may use that word. And I think with the given context where you are seeing that the order announcements are also improving, I think these should help these companies. But on the other end of the spectrum, which I sort of alluded to at the beginning, is that some of these sectors, like you mentioned, are also darling. So there's a lot of narrative which has also got built very quickly. So one has to be careful about the valuations. I would sort of caution right now to increase significant exposures here. Maybe at certain point when there's some consolidation or they give up some returns for whatever reasons. I'm not saying that they may fall, but I think those should be the price points one should sort of think about for enhancing the exposure. So I think that's my personal opinion on the category.
Wrap it up with one more sector where, in a sense, the first 6 months it has emerged as the sector of the year, autos.
Yeah.
Is it like a deep swell in autos, or you think the sector genuinely has some more potential left? Growth versus valuation comfort is there.
I would sort of believe that the sector does have some more potential left, and for a simple reason, Nikunj, here. See, whenever I see the business cycles, the business has actually seen the worst phase in the last 3 years, and maybe we have recovered some bit in terms of passenger car, commercial vehicle, tractors, two-wheelers are still struggling. I would say that we've not seen that full-blown recovery, and it is not that we may see that quickly as well. But I would sort of try to respect these cycles. In the past, we have seen that 2-3 years of bad cycles gets followed by 3-4 years of good cycle. So maybe intermittently we may have some bit of fluctuations because the economies are not stable as of now. But I would still believe that from low to highs they still have a good ground to cover, and the valuations. When I think that at the cycle highs, if I have to think about their earnings, then the valuations also look reasonable. So there are pockets within autos which should do well. I think YTD, this has been the second best performing sector, if I remember right. And we had decent exposure in the category. We are continuing to own. We believe that there's some more juice left, and we would want to own this for the next 2 years maybe, because we believe that the category should see business cycle improvement over the period.
Vineet, good to have you on board. Thanks so much for joining in and sharing with us your perspective on IT in particular, as well as the markets as a whole. But IT really seems to be that very sore spot in the markets today. Can't get our eyes off Infy. Perhaps not entirely unanticipated given what was delivered yesterday, but currently staring at a 100 rupee cut. That's 7.5% nearly at 1341. Remember, the kind of ADR move, the kind of pre-open move as well was indicating just this. So that gap down has been seen in Infy. Just have to wait for the rest of the day to see whether or not this trend continues. And I just want to flag off the rest of the IT basket as well, because it's not isolated to just Infosys. We've seen the trickle-down effect play out in the other IT majors as well. Tech Mahindra, TCS, HCL Technologies, Wipro, all of them under pressure, but of course nowhere seeing cuts as deep as Infy. All right, that aside, let's put the spotlight on capital goods then. And we've got Mr. M.S. Unnikrishnan. He's the former MD and CEO of Thermax and an industry veteran, joining in to discuss the outlook for the space. Thanks so much for taking time out. And I think our curiosity in the sector is only further deepening because of the fact that the parent company of ABB India, ABB Global, declared their results, and there's been a decline in the order inflows quite significantly. 2 out of 4 of their businesses recorded a single-digit growth this time around, and even their order intake in some of the regions like Middle East and Asia have declined. Is there a worry of this being a telling sign of the entire capital goods industry, Mr. Unikrishnan?
I think market is overreacting to that trend because most of the European-based capital goods companies, which ABB is one of them, maybe Siemens to a certain extent, may have a minor reduction, not a substantial reduction in order intake. In fact, they had a minor growth in order intake only. But if you look at the details of their report also, both in India and some other parts of Asia, they've had excellent growth available. They had substantial drop in China. So I would say that the companies which are dependent upon domestic industry, the capital goods industry, are all in very, very good shape. In fact, all of them are plumb with orders. They'll find it difficult to execute most of them in the current year. Some of them will get spilled over to the next year. And the outlook based on the new capacities getting created within the country is very bullish, I would say, at this moment of time for the Indian-oriented capital goods industry. And there are some of them which are Indian companies like Thermax, which also export outside India. Also, which comprises, may not be substantial, but between maybe 20 to 30% of their top line do come from outside India. And those are dependent upon China in that export. They may find it a bit difficult. But otherwise, I would say Saudi Arabia, many of the Indian companies do export to Middle East, and there things are okay. Southeast Asia is quite okay. So there, I may not expect a growth like what is happening in India, but overall for them also, it is going to be very good. Then comes the multinationals, MNCs who are operating also in India. But the Indian operations are not very substantial for them. For example, if you were to look at ABB in a quarter, their revenues are around $8.8 billion globally. Indian revenues could be in between 1 to 2 billion. I mean, a quarter will be less than $1 billion, much lower than that. So their Indian portion is much lower. So even they will escape. I don't think the market need to be unduly worried about one quarterly report of one company, that too a Europe-based company.
I like to then talk about the domestic factors here. And there is a big election cycle at play. In your experience, historically, when we go close to a central election cycle, could there be delay in decision making? Do you think long projects which are about to be signed up, they get pushed back, the files don't move forward? Do you think that in a sense could be a real risk? It may not appear today, it may not appear next quarter, but let's say starting from next calendar year, it will appear?
To a certain extent, especially for the government projects, the PSU-oriented orders and also the government contracts related to that may have a slowdown, may not. I would say that it will have a slowdown. The focus will shift a lot more, and many of them may want to wait and watch for the election results to be coming in. But that will be only, I would say, contracting companies, not the real EPC companies. The larger engineering companies of India depend a lot more on private capital, both in India and outside India. So they will not unduly get worried about. And over and above that, irrespective of government, whichever is the government, the capital goods industry depends upon the capacity utilization of their customers. And luckily for Indian companies now, most of the, including commodity industries, are hovering between a 65 to 75% capacity utilization. It's a reordering level. So many of them have placed orders, many more are going to be placing. And normal time that is going to be taken up. For example, if you're going to set up a steel plant, it is 4 years from the day when you have the first order concluded. If it's even a solar power plant, it's not less than maybe a 24-month period, because that's something which is growing very fast in the country. Heavy chemical industry would take 3 to 4 year period of time. A cement plant will take 3 years. So you cannot be postponing such decisions if you're already at a capacity utilization. For example, it's even at 75%. He has to place an order. In case if it doesn't do, he will lose the market share 3 years down the line. So exactly as you mentioned, Nikunj, it is going to be, they are not going to be unduly worried about it. However, those who are in the road contracting, EPC orientation, where they depend a lot more on the government agencies and even PSUs, I would say that there could be some kind of a concern. But that also, I don't think it's such a bad situation in the country right now. Political uncertainty is not prevailing. I don't want to comment on the current situation, but I think there won't be an uncertainty activity in the country at all going forward related to that either.
Okay. If you have to, let's say, tick mark 3 categories where you think the growth for next 2 or 3 years within the capital goods space would be substantial, which are those 3 categories?
First and foremost will be the renewable energy sector, both wind, solar, and offshore wind, which is going to be starting. 3 of them will be the number one. Second will be related to setting up capacity in API-related chemical industry, chemical pharma industry, the plant making for that, equipment making related to that process plant. I would say, let's say entire process plant industry, chemical, pharma, in large to big size. That's the second largest one going to be coming in. Third is going to be food processing industry. There is an explosive growth going on and going to be anticipated. They may not be thousands of crores of investment, but this will be hundreds of companies coming in with the investments of maybe between 100 to maybe 500, 600 crore. And it is going to be across the country, not limited to one area alone. Because these are the 3 critical areas I would talk about.
Okay, what about the outlook in terms of deal finalization orders, Mr. Unikrishnan? Is there a worry that due to the election year that we're heading into, we could see a delay?
I don't think so. Because in any case, predominant part of the orders that happened in the recent past are from private industry. May it be cement, as I mentioned about the solar related, but there's not a single public sector order. Everything is in the private sector only. And second is, I spoke about chemical industry, not one which is government oriented. All of them are very clear about Indian industry is going to be continuously growing for a fairly long period of time. Unless there is some total political upheaval which is going to happen in our country or globally, I don't think capital goods industry should unduly worry about it. Quarter over quarter, don't look at it beyond the level for capital goods industry, because in a quarter they can have a reduction, next quarter it may be made up also. Irrespective of the election results, whatever could be that, this industry will continue to be growing in the coming years.
So do you see this more like a 3 to 5 year phenomenon, or it's not going to be a 3 to 5 phenomenon? It will be sugar rush for next 12 to 18 months.
I would say 3 years I would give a run. Then there will certainly be, because the capacities are bulk in nature. For example, when you set up a new capacity for a steel plant, nobody would set it up less than maybe 3 million tons per annum. For that plant to be reaching a capacity utilization level of maybe 60%, 70%, one should anticipate maybe 3 to 4 year period of time. So there is a maturity after the 3 years. So many industries will set up a capacity, then wait for that to reach to a reorder level. So I would say, depending upon which segment are we talking about, between 2 years to 3 years is going to be a good run. Thereafterwards, there could be a little slowdown. And then depending upon how things are going to be panning out for India, if we cross a 5 trillion size by the time, and then we are making a plan for the 5 to 10 trillion, certainly there will be capacity addition happening. Remember, capital goods industry depends upon capacity installation, capacity building in the country. And currently, nobody is talking about capacity is not needed in the country. On the contrary, everybody today talks about, even say G20, the finance ministers who came over here, the people who do matter, what did they talk about? That India has got a chance of China +1, which is a story that all of us should talk about for the past maybe 5 years. But globally, everybody started talking about it. And we can see that the Chinese economy is shrinking, which they may not be publicly talking about. It's known to all of us that there is a major concern over there. And many of them will want to have the new capacities not set up in China anymore. Even if there is a demand, even if the economy of developed world were to be picking back, they're not going to go back to China. Yeah, India will have a major share of that coming over. Okay? Of course, there will be Vietnam, there will be Thailand, there will be some of the Southeast Asian countries will get benefited partially. But the main beneficiary for this is going to be India. Absolutely. Very clear about that.
Unikrishnan, appreciate your time. So glad you could join us. Now, what do we have on the market on a day when Infosys has got smoked? Literally, that's the word. Now down 8.5%. The markets have not fallen apart. So there is no Reliance, there is no Infosys, there is no ITC. And the cut on the index, is not excruciatingly high. It's 120 points down on the Nifty. That's it. So a little bit of buying comes back into banks, which is what I think is visible, because all PSU banks are marching up very, very smartly. Can Bank, SBI, CUB and IndusInd Bank. Then the market, in a sense, could really, have a smart close as well. We missed the 20,000 mark by just 20 points. If there was no casualty from Infosys, trust me, it would have happened today. Infosys also has not really fallen flat. The pre-open rates did look scary, but after that looks like some contra buyers have come in. I mean, we understand that insurance funds like LIC are big contra buyers in some of the IT names now. I mean, you got to bear in mind that these companies have high return ratios. They generate a lot of cash. They're doing buybacks. The business was going through a sugar rush post-COVID, and now I think growth concerns are there largely because of deal cancellations. But things will settle actually. Let's shift gears. Shanay Shah joins us, president with Shalby Group of Hospitals, to understand that how things have gone for his company for the quarter gone by. Good morning. Thank you for joining us. If I look at your numbers, margins, well, they've remained flat, whereas on all other parameter, which is EBITDA and revenue, there is a growth. So should we really take a deep dive into these numbers and understand that when business is growing, why are margins coming down?
Good morning, Nikunj. Thank you for having me. Yes, the performance has been quite strong on all parameters. And in fact, we are looking at 20% kind of growth in the revenues and the EBITDA. We've also achieved a 20% kind of ROC level in the hospitals business for this quarter. So we are quite happy with the performance. The margin expansion, with regards to the margin expansion, we have continuously been investing in building newer specialities in terms of capabilities. And, because of that reinvestment, into the business for further growth, we do see that, the margins have remained flat. However, with some of the drives that we have initiated over the last 3 months, we will be seeing a margin expansion, towards the second half of this year. In fact, from Q2 onwards.
So, Shanay, the best way of looking at the growth of your company or your hospital chain, should one look at occupancy rates? Should one look at capacity addition? Should one look at international footfall? Because this is one sector where there are a lot of variable factors which are at play.
So I think the biggest upside, Nikunj, in Shalby today is in the hospitals business is really, the kind of occupancy ramp up that is possible and that what we have achieved. So one is, of course, the fact that, yes, the volume growth has been more than 13% year on year and much higher on a quarter on quarter basis. But also the ARPOB growth, the average revenue per occupied bed, if you see, has grown by 8%. So we are inching close to 40,000 rupees, as an ARPOB now, which is very high for, given the kind of towns and cities we are present in. So, it will be twofold really in the hospitals business. And of course, some of the newer businesses, we'll be seeing a much higher growth, like the implant business and, the franchisee business, you'll be seeing a much higher growth. Like, just to give you an example, in the hospitals business, some of the mature hospitals have grown by higher double digits, but most importantly, some of the newer facilities like Mohali, Jabalpur, Surat, Naroda, these combined have a capacity of about 1,000 beds, and we have grown 50% on the revenue year on year, and the EBITDA has grown fivefold on a year-on-year basis in these units.
Okay. So what is the guidance for a new bed addition in the existing capacity and pure greenfield expansion?
Well, as you know, we already have 2,000 beds as a capacity, and we already are kind of at an occupancy level where we can see a good 20% kind of growth year on year for next 4 years without doing any capacity addition. So that is on the existing capacity side. We have two new facilities coming up. One in Mumbai, which is the Santa Cruz Hospital, about 175 beds, and the other one in Nashik. So these two are the announcements that we made on the multi-speciality hospital front. These will come into play close to 24 to 36 months from now.
I just want to understand the big picture for the hospital industry. This space is getting interesting, brutally competitive, and it's a space where right now PE investors have also kicked in order to bring in efficiency. What will happen to the hospital space when you've got multiple hospital space who are expanding and they're getting access to PE companies and they're getting access to equity capital? How will the industry dynamics change? Because this is an industry where very interesting positioning now clearly is at play.
So Nikunj, you're absolutely right. This is once in a century kind of opportunity. It's a decade opportunity that we feel we have, and this is kind of also stamped by all the FIIs that have been investing in as strategic partners, also as silent partners into these businesses. It gives us a lot of confidence. Having said that, yes, a lot of new capacity needs to be coming in because most of the strategic partners have been taking over existing assets, but there is a huge potential to build newer assets as well. So, which is where Shelby is focusing on. We are looking at inorganic as well as organic opportunities because we believe that the run-up over the next 1 decade is going to be significant in the hospital space.
Ross, a number which institutional investors they always look at, it is at an enviable rate of 30%. 30% is what even FMCG companies don't command. Now, for a business which is capex dominated, for a business which has cyclicality, for a business where operating leverage benefits have not kicked in, how are you managing 30% and will it sustain?
Did you say 30% EBITDA margin?
No. You mentioned to me at the initial part of your question that your ROS, ROE.
Yes. The ROCE, Nikunj, for us in the hospital business is 20%, which is much higher than most the industry average. And at this point of time, we are still at a capacity utilization where we can really kind of double the top line in the hospital business. So when we really ramp up, you will see these ROCs inching close to 30-35%. So these are quite significant in nature.
It becomes 30 operating leverage benefit would kick in. Will that happen in FY24? Will that happen in FY25?
No, we'll start seeing this, Nikunj, over FY24 as well. And we'll see it inching up over the next 3 to 4 years because, as I said, there is a significant upside which we have. So, we look to add 1.5% to the EBITDA every year as an additional margin that we'll be looking at because of the margin expansion and operating leverage, as you did mention.
Okay, great to join you on the show, Shanay. Thanks so much for taking the time out.
Thank you.
Let's now welcome on board Nitin Rakesh, the CEO at Infosys, and Manish Dugar, the CFO, joining in right now to talk about how their earnings went by. Gentlemen, great to have you on the show. If we could, just firstly talk about the revenue, which has actually seen a decline and more than anticipated and expected this quarter because of the BFSI weakness. Do you think this is the bottom and should we expect a recovery from the second quarter onwards?
So I think it's fair to say that I think across the industry, we are seeing some real pressure on discretionary spends as well as cyclical, downturn related issues. So for us, this is a little bit more acute because our percentage of revenue from banking is probably the highest in the industry. The good news, though, is that at the back of our large deal wins in Q1, which we hit a new record by quite a distance, and some of that is giving us conversion as we speak. Second, we've already seen signs of early volume uptick in the mortgage business. Clients have actually asked for capacity expansion in anticipation of volumes going up. And a little bit more unlocking or unclogging of the decision making is visible given the pace of deal wins. We do think that we bottomed in the Q1 numbers. So we expect to see a pickup in sequential growth through the remainder of the financial year 24.
Now, there has been a lot of dichotomy in deal wins versus revenue execution. Your deal wins were very strong this quarter. Explain to us why is there a dichotomy?
Yeah, I think firstly, the deal wins in the last 4 quarters, the average was in the 320, 330 range. This time, we've actually got double of that in 1 quarter. So the deal wins are up more than 100%, both sequentially and on a YOY basis. So this is a step function change in the deal wins. And hence, that obviously has a bearing on both short term as well as full year numbers. Secondly, yes, you're right. The conversion from pipeline to TCV was clogged. Even after you close a deal, conversion to revenue was taking a lot of ramp up time. And of course, The third element that adds into growth is the leakage of a volume ramp down or existing business. And just in the last 4 quarters, we've seen more than a 50% decline in our mortgage revenue on a quarterly basis. So I think what we are now saying is that we've seen the bottom of our declines in the mortgage business, so that leakage is taken care of. We've also seen the bottoming out of our DXC revenue line because we now have visibility into stability over the next few quarters. That leakage is taken care of. We are seeing unclogging of the decision-making cycle because conversion is picked up quite dramatically. So that's definitely giving us a lot of optimism around the ability to continue to convert deals because the pipeline is still up both year over year and sequentially. And finally, we've also seen green shoots in pickup in activity on the banking side, which is kind of what really drives some very short-term growth opportunities because the portfolio is actually that focused and a lot of our top clients are in that domain. So I think it's fair to summarize that pretty consistent across all parameters. We are starting to feel a lot more confident that we've bottomed out and the base formation that we've done in Q1 will really become a foundation for us to continue to see growth through the remainder of the year.
So if we can shift focus and if you can tell us how Infosys is working towards lowering the BFSI exposure, tell us more about the efforts taken by the company on this front.
A few months ago, we announced a vertical cohort GTM structure, which combines our account-based model with an industry alignment on the go-to-market side. And the idea was very simply, we have had real success in growing some of our large accounts into really, 100 million plus or 150 million plus accounts. Our hope and our focus is to actually take that same playbook into the next set of accounts that have been acquired in all verticals. So this quarter, substantial number of our TCV deal wins, both as a percentage of TCV as well as a number of large deals, have actually come from outside our top 10 accounts. Second, we talked about also expanding our footprint and our focus in the non-BFS segments, because again, that goes towards broad-basing our growth. We've seen fairly strong growth, both in terms of revenue. Sequential revenue has actually grown in TMT by 6%. It's grown in insurance. It's grown in healthcare. And I think we are almost, starting to see recovery in logistics and travel as well. So I think that strategy is working. We are very confident that our efforts in really starting to create growth drivers outside of BFS are now starting to take effect at a pretty rapid scale. Thirdly, we've talked about geo. US banking obviously is the biggest exposure. We've seen a 5x expansion in our pipeline in Canada. We actually have one large deal in Canada that was signed in Q1. That deal is for over $40 million. That actually is 10 times our quarterly run rate, so to speak, in terms of, so the impact of that deal in that region is pretty substantial. And the pipeline in Canada is actually up, as I mentioned, 5x. So I think we have a similar story with pipeline in Europe, even though conversion in Europe has been slower than in Canada.
Right. Manish, talking about margins, your target EBIT margin guidance of 15.25% to 16.25%. What levers do you see of hitting the upper end of the range?
The philosophy of maintaining margin in a narrow band while investing for growth, we had shared our confidence on ensuring that it's not only going to be within the range, but with an upward band. It's a small uptake, but it's at least a movement from 15.3 to 15.4. And we feel confident that this will continue in that direction in the coming quarters for the year. This is despite the challenges that we had in revenue and all the macro effects that came into being, including the impact of compensation that was kind of carrying on for some while. As we look forward, the supply environment has become a little eased. We are confident of our ability to now deploy freshers, which is one of the things that we have been working on for a while. And we are also seeing utilization improve as we go forward. So on an overall basis, there continues to be tailwinds to profitability. And as revenue scale starts coming back, it will only aid that acceleration in terms of the northward movement. So as we go forward, not only do we believe we will be able to expand the margin, we will be able to do it despite making investments, which we had kind of slowed down a bit as the environment was not supportive of such investments.
So Nitin, going forward, do you think that the momentum in the deal wins is here to stay and you'll revert to the $300 to $400 million range?
I think two things to note. Firstly, the big bump is obviously driven by large deals, but more importantly, a third of the TCV came out of pure AI deals, which means the opportunity presented by the extreme amount of executive focus on driving efficiency and transformation through use of all forms of AI is actually starting to pick up as well. I just want to make sure that we didn't lose that nuance in the TCV numbers. I think in terms of what's the sustainable growth rate or what's the sustainable closure rate, I think the lead indicator is always pipeline. Pipeline is up more than 20% YOY and 6% sequentially. So I think if the decision making continues to ease as we've seen early signs of, we do believe that we can continue to see healthy pipeline to TCV conversion through the remainder of the year. Hard to give a number because obviously large deals are by definition lumpy. But I think if we continue the trajectory of focusing on large deals as well as driving growth in our existing relationships through organic smaller deals as well, I think we should continue to see a good trend on the TCV side.
Thank you so much, gentlemen, for joining in and sharing with us the roadmap ahead for Infosys. Let's pull up Utkarsh Small Finance Bank. Today's stellar listing, 40 rupees is what it listed at on the NSE versus an issue price of about 25 rupees. And largely on the back of the fact that you have, the expectations that it would have been a healthy listing, reasonable valuations. The company has pretty strong financials as well with improving asset quality. There's been strong growth potential as well. And more importantly, it was a 500 crore rupee public offering. It had seen very robust response as well from the investors, subscribed something like 101.9 times during 12th to the 14th of July. Second public issue that we've seen this year that's got more than 100 times subscription. This is, of course, after that bumper response that we saw to Idea Forge. So clearly, you did see a stellar debut coming in of nearly 60% on that company, and that was pretty much the expectations. Strong growth potential, as I said, the fact that you've also got an improving financial performance, the response as well had been fairly healthy. The expectations were going in high given the company's strong track record as well. So there it is, currently settling around the 40 rupee mark, a solid 60% premium, a bumper listing at that.
Okay. For the management, you go public, it's a big day. So congratulations to the management of Utkarsh Small Finance Bank. I don't track the small finance space that closely, so I'm going to refrain from talking about the valuations here because, this is one of the issues I had given it a skip. But interestingly, if you look at the whole gambit of the small finance bank, not everybody's managed to hit out of the park. But there are a few success stories here. The one big success story that comes to my mind immediately is AU Small Finance Bank. What happened to AU Small Finance Bank? I mean, it has really moved to a different orbit in terms of positioning, in terms of risk management, in terms of NIMs, and in terms of the commanding share they at least have in the vehicle finance business. Bandhan, on the other hand, has struggled even though they represent the microfinance space. So they actually have struggled in the same space. You got Fino Small Finance Bank. They've also struggled even though they have a lot of prowess of technology. But the challenge with the small finance bank is that the cost of liability is something which they always struggle with, because and at a time when there is in general a war of liabilities, the liabilities they normally move to big franchise, they normally move to a lot of big banks and big PSU banks. So that's where I think the struggle for some of them has been. But Utkarsh Small Finance Bank is off to a good start, and even though the recent listings of late really have been from the drone space, they really have been from the technology space, they really have been from the jewelry space. I think from the financial space, if my memory serves me right, this is the first one, at least of this calendar financial year.
Yeah, it is the first. Utkarsh Small Finance Bank is the first. We've had many new businesses actually come to the index and many new age businesses as well. But the first from the financial space. At the issue price of 25 rupees per share, the grey market premium was already indicating a big upside to the stock, and upside it sure is, about 14 bucks or so, 39 plus levels per share on Utkarsh Small Finance Bank. What a dhamaka offer listing. Actually, most of the new recent listings have been good ones. I mean, from Idea Forge to Utkarsh.
Yeah, you know, A, some of these businesses are niche. B, if you talk about the size is not that large.
Yeah.
You know,
and also, I think, Nikunj, the learnings from the class of 21, you know, put some money on the table for the retail participant to make money.
You get goodwill. I mean, if you are in the business, if you're in the business for long haul, and if you're confident that your business will grow at 20 to 25%, then stock market will reward you. If you leave money on the table, then you know you would be remembered. And if you need to come back to the capital market ever, markets the same folks will actually reward you. I mean, look at banks and look at, you know, classic story here, Aisha, is Reliance. What was started by the great legend himself, Dhirubhai Ambani, always take care of investors who bet on you. And look at the wealth Reliance has created. I mean, even this whole idea of creating Geo Financial Services and giving a free share, it is a clear indication that you are rewarding the long-term shareholders. In COVID, they came out with a preferential issue when they wanted to raise capital. That also created a lot of shareholder value wealth. So it's always good. I mean, if you get trapped into the rat race of getting a high premium, listening to the merchant bankers, with all due respect, they are working for fee. They're not working for the retail investor. Then time and again, you've seen those in downturns, those stocks they suffer. Paytm, Zomato, Policy Bazaar, Nykaa. Nykaa just went a little bit here on the corporate governance. It's not popping up on our screen. When was the last time we discussed Nykaa?
Yeah, exactly.
Don't recall.
Don't recall.
And today too, most of these stocks are under pressure. By the way, let's just check in on where Infy is settling in at after that gap down start. Not seeing any recovery, not just for Infy, but for any of the IT names, by the way. Infy is still down 6.5% in the future, 7.25% lower in the spot market. TechM is the other laggard in trade. You're seeing Wipro, HCL Technologies, even Reliance, which is down 1.5%, and TCS also, which is down 1%. Having said that, the rest of the IT names surely have seen a recovery from those gap down starts that they had. TCS being one such case in point. Infy too, a smidge of a recovery, but you know, like Kunal was earlier mentioning, that every uptick on TCS, on Infosys, I beg your pardon, does have opportunity to get sold into. So let's see whether you actually breach that opening gap down, that of roughly about 9% or not on Infosys. And can we actually hold on to that 1300 price point, which we were on the brink of just breaching right on opening?
Bring the crew back to dealing room. Nifty is down only 80 points.
Yeah. And L&T, SBI, they're all doing the magic.
Yeah, so that's how markets rotate. I mean, the most performing sector is actually banks. If there would have been a casualty in banks, then you would have said, okay, Nifty is going to slip more. Yeah. IT is a weak sector, and that and heavyweight has gone through a tough time, so to speak. So it will be back to where Infosys positioning was, let's say, 3 months ago, 4 months ago, where everybody said, okay, we'll bat on a decline. And it's not fallen completely. It's not got trashed out, even though the gap down start in the morning was slightly scary. Let's take a break. The good news is that we've recovered, and we've recovered smartly from the day's low and down only, and I say only, 130 points for the Nifty.